Welcome to the Cardinal Commentary for the Canadian equity portfolios. Everybody knows Canadian Tire. The iconic retailer seemingly sells just about everything: tools, sporting goods, barbecues, kitchen supplies, and auto parts. And, as it's been reminding customers lately, it even sells tires. But did you know Canadian Tire has also been an incredible investment? It pays a 3% dividend yield, and last year, it increased its dividend by 10%, continuing a lengthy trend, while earning nearly $19 per share. How does it do it? Well, for starters, it sells its own in-house brands, like Motomaster, Mastercraft, and Yardworks, which account for nearly 40% of its total sales. In-house brands have higher profit margins, and they're not subject to the same supply chain challenges as other brands. It also has a very successful loyalty program called Triangle Rewards, which has 11 million members. Just how valuable is a loyalty program? Well, Triangle members spend an average of 75% more at Canadian Tire stores than non-members. Canadian Tire has been one of the biggest beneficiaries during the pandemic, as customers have flocked to its stores for help with a wide variety of do-it-yourself projects. But the company has been built to do well no matter what the economic conditions. Portfolio manager Evan Manser says not only is Canadian Tire a market leader that's trading at less than 10 times earnings, but it has also expanded its retail footprint through a stream of acquisitions.
When they first bought Mark's Work Wearhouse way back, I think a lot of people, including us, were questioning whether they'd have the ability to veer from their core brand, and yet they've done it again and again and again with success, with Sport Chek, with Party City, with Helly Hansen now, with lots of in-house brands, and they've demonstrated that they've got an ability to take these acquisitions, make them better, and keep growing.
The Cardinal investment strategy is to buy market-leading companies that can build value, increase their dividends and income streams, and keep pace with inflation. Canadian Tire is just one of many companies like this in our portfolio with rising earnings per share. But it's not enough to just buy great companies. You have to purchase them at a good price, and that's exactly what we're doing. We're buying companies at an average of 14 times earnings. Last year, you could have bought Spotify, a market leader in e-commerce, for nearly 300 times earnings. So, we make the very important differentiation between a great company and a great investment. Businesses that grow their earnings are also able to grow their dividends. 5 of the companies in our Canadian portfolio announced higher dividends in the first 3 months of the year. Last year, the average dividend increase in our portfolio was 15%. Evan Manser believes the portfolio is well positioned even in an environment of rising inflation and rising interest rates.
And higher rates are, especially in the initial phase of hiring rates as we're in now, is really powerful for earnings on financials. So if you look at a bank, for instance, and you look at their costs, that's their deposits. Now, if you're like me and you're a bank client, your deposit rate has not been going up much, even though you're seeing all these reports of inflation and interest rate increases. I'm still getting zero, just like I got zero a year ago. However, on the lending side, as soon as the Bank of Canada makes an increase in the lending rate, in the overnight rate, banks are adjusting that right away. They're adjusting their 5-year loans, their 10-year loans. So the revenues are adjusting up, and a big portion of the expenses are staying the same. And if you get a few more basis points on that net interest margin, a little higher percent, and you're like Royal Bank and you have got $1 trillion of assets, anything times $1 trillion ends up being pretty accretive to the income.
Energy, communication services, and consumer staples have contributed to an impressive return for the portfolio of 9.6% in the first quarter. That's about 2.5 times higher than the S&P TSX over the same period. We know that one quarter is hardly long-term performance, but we're confident that buying good companies that grow their income and their dividends will lead to growth in our clients' wealth and incomes. If you had invested $1 million in this portfolio 30 years ago, it would be worth more than $13.1 million today, compared to just $5.8 million if you'd bought the index. And why do we do all this? Because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.